Robinhood stock has been on an absolute tear, up over 229% this year alone. But if you're like me, you're not just chasing growth, you also want income from this bad boy. That's where ETFs like HOOW and HOOY come into play. They promise massive yields, some of the highest in the market right now. But here's the real question. Do these ETFs actually beat just holding Robinhood itself? And more importantly, do they fit into a real portfolio strategy, or are they just dividend traps in disguise? Stay until the end, because I'm going to share exactly how I'm using these ETFs in my own portfolio, including why I don't drip these ETFs and where HOOD itself fits into my long-term plan. Let's go. Before we dive in, this video is for educational and inspiration purposes only. I am not a financial advisor. Specifically, I'm not your financial advisor. And there's nothing in here that's financial advice. Always, always, always do your own research before investing. And with that out of the way, let's get back to the income. Okay, let me set the stage. And here's a quick rundown of each fund we'll be looking at, plus Robinhood itself. And just so you know, these numbers come from Snowball Analytics, which is my go-to for tracking my portfolio performance. If you want to try it out, there's a free trial and a 30% off link in the description below. That 30% off is for a limited time only, so definitely jump on it if you enjoy Snowball. And Snowball isn't a sponsor. I just really like their product and I am an affiliate, so I will get a small commission if you do sign up. But keep in mind, the reason why I mentioned that, these numbers will vary depending on the platform that you use. So if you don't use Snowball, no worries, all good, it's cool. You can also look them up on Yahoo Finance, TipRanks, Seeking Alpha, or whatever platform you prefer. Just remember that these numbers will be slightly different on each platform. And all of these numbers are as of the date of this recording, which is today, it's September 18th. So keep that in mind whenever it is you're watching this video. Okay, so looking at Robinhood, ticker OOD, the price as of today is $122.69. Year-to-date total return is 229.28%. There's no distribution here, no dividends, so this is purely a growth play if you decide to hold it. And the beta is 2.36, which means it is super volatile, and you can see in the graph the trend line is up, but you can see the ups and downs of Robinhood across the year. So this is definitely a growth play. It's explosive, but it is also risky. All right, now looking at HOW, which is the Roundhill HOOD Weekly Pay ETF. So things to note about this ETF is it launched in June of 2025. The current price is $70.98. So far, they've had a year-to-date return of 34.56% with a dividend yield of about 115%, and the annual payout is about $82.33. And also keep in mind, Brownhill's strategy here is to seek 120% of HOOD's weekly performance, plus generate that on a weekly basis. They definitely don't always hit that 120% yield number. In fact, the last few weeks have been sitting around 60 to 80%, but with the Robinhood rebound recently, the distribution yield is back up closer to that 120%. Next, we have HOOY, which is a Yield Max HOOD Option Income Strategy ETF. They launched in May of 2025, and the current price is $67.13, and a total year-to-date return so far of 27.08%. The dividend yield is sitting right around 69%. It's definitely more modest than HOOW, but let's save that for the full analysis. And then the annual payout is about $46.37. And for those of you who are not familiar with HOOY, they use a typical covered call strategy, which comes with the same pros and cons, capped upside, monthly payouts, etc. versus HOOW, which actually pays out weekly, like I mentioned earlier. Okay, we're also going to compare it to ULTY, which is the Yield Max Ultra Option Income Strategy ETF, which the current price is $5.64 with a negative 37% year-to-date return. But this is definitely misleading since Yield Max changed their strategy in March of this year, and then ULTY is been much steadier since. And I bought in around April, May, so I didn't feel that Q1 nosedive. And if we just look at the last 6 months of ULTY's performance, it's actually up 27%. The current dividend yield is 85%, and the annual payout is about $4.82 per share. So I wanted to include ULTY because it's been one of the most popular and polarizing covered call ETFs in 2025. Depending on when you got in or when you analyze it, you would either love it or hate it. And I've done quite a few videos on ULTY, and there's definitely people that love it and hate it. And finally, let's look at QQQ, which is the gold standard for long-term growth in tech investing, which all of these stocks kind of fall into because Robinhood's a tech stock. all these fall into it. So QQQ, which is the Invesco QQQ Trust, its current price is $597.39. Total return so far this year is just above 16%. It's a measly distribution yield at 47%, and it pays out like $2.82. So it's not a lot. But this is a diversified NASDAQ 100 index fund. It's great for long-term growth, like core growth, and it's been around forever. And no one will argue that QQQ is not a good investment. And I hold actually the Vanguard equivalents, which is VGT or VUG, depending on which one you like. So that's the rundown. That's the lineup for today's comparison, just to see how everything performs. But before I dive into the numbers, definitely drop a comment down below. Which one of these would you pick if you had to invest today? HOOD, HOOW, HOOY? Would you go ultra yield, ULTY? Or just stick to the classics, QQQ, VGT, VUG? I'd love to hear your thoughts down below. Pros and cons, go. But then come back for the rest of the video. So let's look at my favorite metric of all. And if you are new to the channel, we'll talk about it. But if you've been around a while, you know that it's total return. And this is one of the base metrics for many of my decisions, that total return. So keep in mind that this is only year to date. And since HOOY and HOOW launched mid-year, that's all the data we're going to have. So here's the raw data, year to date performance as of September 18th. So we talked about earlier, HOOD crushed everything, up over 229%. HOOW came in at 34.6% with that monster yield though attached, keep that in mind. And also this launched in June of this year, so it's only a few months of data. HOOY returned 27% since it launched in May of this year. And ULTY, like we talked about, ouch, down over 37% for the year. But as I mentioned, it's up 27%-ish since they changed their strategy. And then QQQ, quiet and steady, it delivered 16.9%, and it's steady Eddie, consistent growth, almost zero volatility when it comes to QQQ, unless, you know, in the whole market it tanks. But that's another video for another day. And just looking at this chart, it shows exactly why I don't just chase yield. High income doesn't always equal high returns. But what do you think? Would you take HOOD's wild ride, or would you prefer something steadier like QQQ or even SPYI? Comment down below. Okay, now let's run a real life income investing test / scenario. So what if you invested $10,000 into each starting in June of this year when HOOW was launched? So we just doing June of this year, so we can do sort of an apples and apples comparison. So first we're going to look at HOOD versus HOOW. So with dividends reinvested, HOOW actually outperformed HOOD. So if you invested $10,000, you would have $16,013 of HOOW versus $15,142 of HOOD. And if without reinvesting, HOOW still came out ahead at $15,687. So that's the power of weekly payouts. Also that 120% target that they're trying to achieve. Now, if we look at HOOD versus HOOY, it's a different story here. Even with the $17 in dividends per share, HOOY trailed HOOD pretty significantly. So HOOD ended at $17,452, while HOOY finished at $15,317 with reinvestment. And that's the capped upside problem in action. So now comparing HOOD to QQQ, HOOD once again dominated $17,452 versus $11,289 for QQQ. But remember, QQQ is diversified, so it's less risk, lower reward in this short window. So it's short time frame. Just keep that in mind. And now we're going to look at HOOD versus ULTY. So ULTY, despite the huge yield, just couldn't keep up. $11,647 with reinvestment compared to HOOD's $17,452. A reminder that yield can be good for income investors, but you might be sacrificing huge long-term upside. Of course, not counting for the volatility. I was actually surprised when I did this analysis at how handily HOOW beat HOOD. I thought HOOD was going to blow it out of the water just because of that 229% total return. But we have to keep in mind that this is a very, very small sample size. It's only been a few months, so really only time will tell here if HOOW can continue this pace. Or will it come back down to earth and perform more like ULTY or HOOY? Not sure. Again, time will tell. But don't get me wrong, those are also extremely volatile income funds, but they haven't kept up with HOOW either. So Which one of these really surprised you the most? Was it HOOW? A lot of people in my comments actually recommended HOOY over HOOW. I'd love to hear thoughts. What you think about that? Would you choose HOOY over HOOW? There's definitely pros and cons between both. Okay, speaking of pros and cons, let's break down some of the pros and cons of investing into funds like these. Not necessarily these ones, but like funds like these that are individual stock dependent. So some of the pros for HOOY and HOOW: massive yields. HOOW at 116% annualized so far, HOOY at 69%. No slouch. You get weekly or monthly cash flow to pay your bills or to reinvest into something else. And it's an easy way to monetize HOOD's performance without trading options yourself, which can be time consuming, can even be confusing, and trying to balance, puts and covered calls and all those things can be confusing. But some of the cons, right? It's single stock risk. Everything's depending on the performance of Robinhood. If Robinhood does well, you do well. If Robinhood tanks, unfortunately, these tank too. With that said, HOOW actually amplifies the downside. So when Robinhood dips, so does HOOW and so does its distribution. And that can make relying on HOOW's income tough in bearish or volatile markets. Like I said, a couple weeks ago, it was only at 60 to 80% distribution instead of that 120. And then looking at HOOY, it caps upside, which is a tough pill to swallow, seeing how HOOD is up 229% on the year. Also, distributions often include return of capital, which can be good or can be bad depending on the strategy of the ETF, which if you're familiar with this channel, we talk about when return of capital is good and when it is bad. And then, like I said earlier, it's a limited track record. They're brand new. Only time will really tell. So while these funds can definitely increase or pump up the income in your account, they're not the set and forget it types. They're not like QQQI or SPYI. You definitely have to keep track of Robinhood to make sure these continue to make sense in your portfolio and so you don't lose a lot, which could happen. Robinhood's been pretty volatile over the last 2 years. So here's how I'm personally handling these different stocks. I actually hold HOOD. It's directly in my rollover IRA, and it makes up about 1.5% of that portfolio. And this is kind of my growth sandbox. That's where I like to play. And it's definitely not a huge allocation, but I am up around 18% for the year. I got in later than I wanted to, but hey, better late than never. It was volatile last year, so I was hesitant. I do hold HOOW in my taxable account. And again, it's about 1%, and I don't drip. Instead, I use the weekly income to fund things in my life like bills, but I also build long-term positions like QQQI, SPYI, GPIQ, BTCI, things like that. And truth be told, I'm not 100% confident that it's a long-term income play, so I'm hedging with my steadier plays. And keep in mind, my taxable account is my salary replacement machine. My IRA is just my long-term growth engine. Hopefully, I never even have to touch that in my life because I've created dividend income. As for HOOY, I don't hold any, and it doesn't make sense for me since I already have HOOW, which has outperformed HOOY, and I also have HOOD. So I don't really see the need to hold HOOY when I already hold those two. Plus, I've been burned before by TSLY, NVDY, MSTY, so I keep my single stock ETFs relatively small. They're satellites, they're not really core holdings of mine. But that being said, do you hold single stock ETFs? Do you like these in your portfolio? Or do you prefer baskets like QQQ or SPYI? I'd love to hear from you. Keep the conversation going down below. So after all of this, you may be asking yourself, are these single holding covered call ETFs right for me? Well, let's talk about who these might be right for. So these funds might be a good fit for income hunters and investors who understand the risk and monitor these positions regularly. See this guy? It could be good for retirees looking for yield, but okay with stomaching some of the volatility that comes with HOOD and HOOW and HOOY. Could be traders who want to monetize HOOD without writing their own options, and they may use those funds to build other positions. That's what I'm doing. But who these are not for is just as important. So if you want to be a passive investor who wants stability, if you're a set it and forget it type, these are not for you. Definitely move on. You probably want to go something like more like QQQ, SPY, VOO, something like that. This also isn't for anyone who can't handle drawdowns. This is part of the nature of these funds. They often replenish these funds, but they do drawdowns and they do use return of capital as a strategy. So if that's not for you, stay away. Also, folks who confuse yield with safety, I hope this isn't you. And if you're watching my videos, I doubt this is you because we know better, but I still have to point it out. Okay. In the end, Income is not free. You're often trading upside for immediate income, and you should definitely know that cost and know that trade-off. So personally, I love income plays like HOW, but I trade carefully. I keep them small, I don't drip them, and I use the cash flow to build the kind of portfolio that gives me long-lasting freedom, not just makes me a quick dollar. So that's it for today. Thanks for watching. If you got value from this video, please give it a thumbs up and subscribe if you haven't already. I appreciate you all. A lot of you are really active in the comments and I love it. If you want me to do a mailbag, I'd be happy to do it. Have an amazing week. If it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care and I'll see you next time. Boom.